G'day guys, Seeney here and welcome to another episode on the Australian Wealth channel. And in this video, we're going to be talking about the complete guide to negative gearing in Australia. So thank you guys so much for tuning into this video. Please make sure you like and subscribe to the channel. Really helps to get these videos out to more people. So we're gonna get started with negative gearing. So this is in fact a strategy that people use to invest in property around the world, but it is a particularly popular strategy here in Australia. So I think the most important thing is to start with the definition. So we have negative gearing. So gearing basically means borrowing money to invest. And if something is negative, it means it's going down. So we're looking at borrowing money to go down, which doesn't sound so great, but I'm going to explain this in a little bit more detail and as to why so many people decide to use this. So negative gearing is when you borrow money to invest in an asset such as a house, and the income that you receive, so that might be the rental income that you get from tenants, that money that you receive is less than the expenses. So it's actually costing you money to hold the property. So expenses, for example, would be things like repairs, the mortgage, property management if you have that kind of thing. So let's say that you're bringing in $2,000 a month in rent, but the mortgage and the property management end up costing, $2,500. You're losing $500 every single month. So now there's a lot of expenses that you can put under this banner. You have your mortgage management fees, repair costs, as I've said, but it can also include things like depreciation on the building. So as we know, things age over time. They start to get run down, as we've seen in properties from like the 1940s, 1950s. They're just in nowhere near the condition that they were when they were first built. So one of the tax laws allows real estate investors to depreciate the construction on an investment property. You're not allowed to run the depreciation on the land, only the construction. So let's say the construction costs you $400,000, then you would get to write off roughly about 2% of that every single year over a set period of time. Many investors will use negative gearing as a strategy in their portfolio. So why on earth would anyone want to make a loss when they're investing in property? It doesn't make much sense until you have a look under the hood. The basic reason that people do this is because they believe that the future capital growth will significantly outweigh the costs of having to negative gear in the short term. The cost of paying, $100, $200 a week to own a property. So that they believe that the capital growth is going to be so strong going forward into the future that it's going to outweigh any of the benefits of negative gearing. So they believe that going forward, the capital growth is going to be so strong that it's going to outweigh any costs of holding the property, even losing money on the rent. But of course, when it comes to negative gearing, it gets even better for property investors. Australian law allows people who invest in properties, and also companies as well, to deduct any losses that they make on a property against their taxable income. So let's say that a property is losing you $10,000 a year, which is pretty extreme scenario, but let's say it's losing you $10,000 every single year because you're having to cover the mortgage and the rent's not enough to keep up. You can write off that $10,000 against your taxable income, reducing the amount of tax that you have to pay at the end of the year. So it's very much a tax strategy that some people use. This is especially effective the higher your income gets because you'll be in a higher tax bracket. Writing off 32% is great, but writing off 45% if you're in that bracket is even better. So let's look at the pros and some of the cons of negative gearing. So the first and probably the biggest and only pro is that you get to write off some of your taxes. Great, fantastic. So that's really good. And now we're gonna have a look at the negatives. So the first one is that you're losing money every single week from your cash flow. So you might be able to make some of this back at tax time. You might be able to reduce some of your pay-as-you-go installments, but you're losing money every single week to own that property. There is also the potential for a dramatic downturn in property prices and your investment fails to increase in value. So now not only have you lost the capital growth that might have happened in the future, but you're also losing money holding on to this property. So you're getting hit with a double whammy. The other thing which I think is really important to note is that negative gearing might make it harder for you to purchase additional properties in the future due to dragging on your debt to income ratio. So if you're paying money and your income isn't making up for that, then that is going to reduce your borrowing power, which is not such a great thing. So these are some things to take into consideration. You know, you might be able to buy in a fantastic area which sees incredible capital growth, but the rents suck. Well, you know, in that case, negative gearing might be the way to go for the long term. However, having said that, my personal view is that you can have both of these things. You can find properties that have great cash flow and will also rise at a great rate. It's just a matter of doing your research and looking in the right areas. So of course, this is something that is multifaceted. You know, it's things like looking at what government infrastructure is going to go in, you know, things like population growth, you know, the average rents, things like that. There's so many different things to look at. But I personally believe if you're looking correctly and you're doing your right research, then you'll be able to find these properties that not only cash flow really well, but are also going to see excellent capital growth. So personally, this is what I'm targeting. A lot of people will try different things and that's fine. Hopefully it works for them. But the reason that I positively gear my properties and will not buy anything it doesn't positively gear is the fact that it also affects my borrowing power. At some point, you're going to run into a wall if you're constantly negative gearing. And even with positive gearing, this can definitely happen. There's a limit, but the limit is much further on, which allows you to get further ahead. And then you can chip away a lot quicker at those mortgages and get into more properties. So that is negative gearing in a nutshell. Please let me know if you or anyone you know is negative gearing and how that strategy is working out for them. I'd say, you know, if they've been doing it the last 20 years, it's probably done pretty well because the property market has just gone bonza. So thank you guys so much for watching. Please make sure you like and subscribe to the channel. It really helps to get these videos out to more people. My name is Seeney. Thank you so much for watching and we'll see you later.